All right, everyone, welcome back to another episode of On the Margin. This is a special episode of On the Margin, and you're going to find out why in just a couple of seconds here. But today I'm joined by Weston Nakamura. Weston, welcome to the show.
Ippolito-san, how are you, sir?
That always makes me smile when you call me that. So I want to give a little bit of context for this. So I want everyone listening to welcome Weston is actually the newest member of the Blockworks team, which I am super excited about. And the reason this is a special episode is because we are debuting his own podcast, which is called Market Depth. And we've got some very specific reasons why we're excited to bring Weston on, outside of the fact that he's just a great chap and we're excited to have him on the team. Weston, you want to say a couple of words about Market Depth, the podcast?
Absolutely. So first of all, thank you personally, Mike, for bringing me on, for having the vision to create Market Depth with me. And so the reason that I'm so humbled and blessed to join Blockworks team is to launch the show Market Depth. What is Market Depth? So basically, in a nutshell, as far as global macro is concerned, we all get more or less the same markets, right? We get the same, euro, dollar, FX cross. We get the same, E-mini futures. We get the same gold, whatever it is, right? And so we don't really need yet another podcast to comment on those sort of, inflation or whatever it is. What we need, and by we, I mean those of you in the United States and Europe, what we need is a different angle, a different perspective to look at markets from that are missing. And so what I'm going to do is, in Market Depth, I'm going to basically comment on markets, mostly market price action and things like that, but market developments, but also bigger picture themes from the standpoint of me being in Asia. And it really matters for several reasons, which we can get into in depth, but to look at it from the Asia perspective, looking at the same markets through that lens, and you have that additional weapon. And it's just frankly something that's completely missing out there. And I think that people might not even know that they need it until they have it. And then once they have it, hopefully they won't be able to, exist in markets without it.
Weston, I'm in complete agreement with you there. Listeners of On the Margin, if you listen to any of the, this is something we've talked about on the show a number of times, but if you've listened to any of the interviews that we've did with Leland from the China Beige book, one of the caveats that we always talk about on the show is we are talking about this from the American and the Western perspective here. And there's often something that we're missing by not having someone on the ground over in Asia, which is one of the many reasons, Weston, why I'm super excited to bring you on the show. The other thing, I think, just a little detail to add for listeners is this is going to be airing early in the morning. So often I will wake up and I'll have to wait for things to go live. But for all you traders out there, obviously, you know that one of the first things that you do is check what happened in markets overnight in Asia, because it gives you some indication of where things are going today. So that's another reason why I'm super excited for the show.
Yeah. With regards to that too, of course there's like pre-market media, coverage and all that kind of thing, right? But the weird thing is, so I was I'm originally from New York, and so I went back to New York for the first time since pre-COVID in this past October, and I was only there for a very short time, but I was trying my best to actually just be a retail investor, if you will, and just try to see what happened overnight in Asia. And there isn't really any discussion of it. It's what's ahead for the U.S. trading day that day. But if some massive PBOC, event occurred or announcement or something, they might, kind of touch on that, but then they'll just completely sort of brush it off. And that can there's that huge sort of like vacuum. And so it's really kind of an incredible amount of like information arb that can be exploitable, certainly, but it's certainly like something like things that you cannot, not know. And the other thing too, I'll say is that with regards to just generally about market price action and stuff like that, a lot of longer term investors might not think that matters, like price action and all that. Here's what I'll say. It does matter if you are a longer term investor as well, for you as well. And so, Market Depth, I'm going to be mostly commenting on, what happened during that Asia trading day across asset classes, FX, equities, single stocks, rates, commodities, so on and so forth, crypto. But the reason that you need to care is because you need to understand like what is driving what. And that comes down to kind of like a granular intraday level. So you don't have to necessarily be executing an order or something like that, but you do need to know what is moving what. a perfect example really is just a moment ago when we just got the CPI print out of the US and
Yeah.
markets move. Well, it seems that markets currently aren't moving on CPI as opposed to every other CPI print where you saw huge moves. And that might
Mm,
be because there's another driver that has introduced itself in the last few days, right? So
mm.
that's if that the Asia version of that is what I would kind of say like, yeah, this happened. This kind of driver normally this data would drive things. However, it did not, and markets were still, and that's nothing happening is information as well.
Yeah, absolutely, Weston. Although I will say that crypto is taking off like a rocket ship, which is
Yeah,
my market that I watch pretty closely. Now, what I want to do is actually give listeners a taste, basically, of what it's going to be like tuning into market depth. And specifically, I want to focus on a couple of the topics du jour, right, that everyone is focused on over here in America, and kind of get your unique spin. And the one that obviously comes to mind, right, which is all of the content that is being produced in the last week, is about the implosion of Silicon Valley Bank. And so basically, if you're a listener of the show, you've probably listened to 10 other macro podcasts basically explaining what's been going on there. I think one of the points that you made, and I want to get your take on this, is that global bank stocks are selling off right now, even though they have little to no direct exposure to U.S. regional. So I would love to kind of get your unique spin on what's been going on with Silicon Valley Bank.
sure. So again, this is another sort of perfect reason why market depth provides value is because every trading day begins in Asia, and that doesn't mean just every trading day. It also means every quarterly rebalance next day, every post options
Mm,
expiry, every single one of those, right? And that also includes every aftermarket, announcement, development or over the weekend sort of thing. And over this weekend, we had kind of like a mini version of like Lehman weekend type of thing where people were kind of locked away in rooms and talking to each other about is there going to be Silicon Valley Bank going to be bought out by who? Is the Fed going to step in, or is the government going to step in, and to what degree, and so on and so forth. But either way, Monday Asia Open is where you see the first market reaction of all that, of the collective sentiment of markets. And so again, that's why that's just another example of why you need to have a show like this. But as far as that's concerned, yeah, so you're absolutely right. Like so, bank stocks and yields, front end yields have been getting crushed.
mm,
And yeah, the like some of those moves in the U.S. regionals, like yesterday, were that's kind of really really insane to me. But it is global, and so you have Euro stocks, banks down, and then in Japan too. Like Topix banks have been down, they're down about 15% or so. MUFG is down, 5%, 5 to 8%, on a daily basis, and is the most heavily traded stock, which is I've never actually really seen that before. For that to exceed, even the like levered ETFs and stuff like that, that are usually the most notionally traded in Japan. But they're just getting hammered, absolutely hammered down, right? And why? Why should that be happening? This is a U.S. regional sort of problem that is solved or whatever. Why should a Japan mega bank with 180 trillion yen in deposits be getting killed like this? So what I would offer is the following: coincidental in timing to the Silicon Valley Bank sort of blow up at the end of last week, starting Friday, was the March Bank of Japan meeting. The Bank of Japan, which was the Governor Kuroda's last meeting, the Bank of Japan held firm on yield curve control, as in they did not increase the band on yield curve control. They did not hike rates, if you will, as many had expected and positioned them to do. Those who were expecting that's basically a bond bullish outcome from the BOJ. And
mm,
so you see yields collapse in Japan. And Japan is the JGBs are the world's duration anchor. They have been, because of the fact that the Japanese investor has the largest net international investment position, as in that they have the most foreign assets. They're largest creditor to the United States, largest foreign creditor to the United States, and all of that. And so, what Japanese people do with their mounds of cash that are yielding nothing at home matters for foreign, bond markets and it's kind of yield seeking behavior and so on and so forth. When the BOJ, let's say since in December when they hiked the yield curve control band from 25 basis points to 50 basis points, you saw a massive spike in yields globally from treasuries to boons and all that. And then you also saw a subsequent massive spike in bank shares, Topix bank shares, and then Eurostox banks as well, right? You saw like I think Deutsche Bank was up like 8% that day off of the BOJ, like lifting rates from 25 to 50 on the 10-year. And so there was global impact, single stock bank impact from that. And then when the BOJ did not continue to do that, as many had been forecasting, and just held firm at 50 basis points on yield curve control for two meetings in a row, you get the kind of reverse of that. You get this isn't like a continuing increase in net interest margin sort of thing. And you have bank stocks that were up, Topix bank stocks that were up 25, 30% within the course of 15 trading days. Now all of that's getting erased. And right now, like if you look at MUFG stock price, it basically just looks like an upside down cup. And so it's just pricing out a lot of a lot of the expectations that were happening. And that's BOJ related. And that happened at the exact same time as this larger story in the media had taken place and therefore covered over a major central bank policy meeting. And so I think that's contributing to a lot of this. And to what degree, I don't know. But the fact that this isn't even noticed, I'm assuming by many, is something that, this is why I need to flag, like, hey, there's also this, angle as well, right? And also, like on yield too, like if you look at the BOJ meetings too, 10-year treasuries, even the front end 2 years, bond yields as well, UK yields and all that, they all spiked when the BOJ moved 25 basis points higher on the 10-year JGB yield for yield curve control in December. They all dropped in mid January when they did nothing, and they all are currently dropping again. So there is like a direct impact from BOJ's actions or inactions. This seems like a continuation of that, but obviously fueled by more.
Hello, everyone. Thank you all for listening to On the Margin. Just wanted to give you guys a heads up about a conference that we have coming up in the new year called Permissionless. I'm sure most of you have been there last year. It is the cultural event of the year. We had over 5,500 people down in Palm Beach. This year, we are moving to Austin, Texas. You know what they say about Texas? Everything's bigger in Texas. So last year we had a really great lineup of speakers. We had the two co-founders of Robinhood, Vlad Tenev and Baiju Bhatt. We had Chris Dixon. We had some of the folks that have been on the show a whole bunch of times, Jim Bianco, Dan Tapiero. Just a phenomenal lineup of speakers, and you can expect the same this year. If you use Margin 10, you'll get 10% off on a ticket. Again, that's Margin 10, because I love you guys so much. Click the link at the bottom of the show notes. Hope to see you there in person. Yeah. So basically, just to, and I want to dig into this idea of the BOJ being kind of the last anchor for duration. But basically, if I understood you correctly, it's kind of a net interest margin story, right? And the BOJ kind of makes that a global thing. Over in the United States, we've got a net interest margin story when it comes to banks, because the collective wisdom on Wall Street is that in order to keep their deposits, which are going to flee from bank deposits into something like money market funds, which offer much higher yields, banks are going to have to raise the amount of yield that they pay to their depositors, and that's going to crush profitability. So I want to kind of dig into this idea with you, Weston, about the Bank of Japan as being a duration anchor, which honestly I've heard that a lot of times, and I get it, I think, at a pretty high level. But I want if you could just break that down for the listeners, and then I'd love to get your take on kind of this new regime that we've got in the Bank of Japan, because honestly, this, I feel like, would have been the biggest story in finance globally if it hadn't been for Silicon Valley Bank. But we had a change in the guard, right, from Kuroda, who's been the governor for a long period of time, to the new guy. So can you just kind of break that concept down of, last anchor for duration, and then talk about the regime shift over in Japan?
Indeed, I will. And Mike, just to plug, that is actually the topic of the first debut episode of Market Depth.
Market Depth,
so,
yeah.
Yeah.
We should have also, guys, this episode is live today. We didn't make that clear. The episode is live, so you can get the link in the show notes. You can also find Weston or me on Twitter or Blockworks. We're going to be pushing it, but you should definitely, basically, as soon as you're done listening to Weston and I talk right now, you should go over and listen to this episode.
Right. So I'll address those two. Let me just, before I forget, just one more force driving yields down that people might be kind of overlooking. So my background is I trade listed derivatives, futures and options at Goldman Tokyo. And so right now is actually quarterly expiry and therefore roll for JGB futures. That was on Monday, last trade date for March to June. The Bank of Japan had, and I won't get into too much detail, but had basically put in a whole bunch of measures that made the JGB 10-year, especially the 10-year yield, or the 10-year securities are yielding securities are really, really messed up right now. Like, look, there's a kink in the JGB curve because there's a lot of concentrated buying. But if you go from issue to issue, like 10-year JGB issuance number 368 versus number 369 or whatever it is, that are like separated by one was issued 3 months within one another, right? So if you look at like just the generic 10-year JGB yield over the last 2-3 days, JGB yield's been slashed by more than half. Right now, the generic JGB yield is sitting below the December pre-yield curve control lift. It's at it's below 25 basis points. But if you look at it from an issue to issue basis, the 10-year JGB yield on number 369, issuance number 369, has a 32 basis point yield. Number 368, the one before it, is currently, this is another 10-year JGB yield, is currently yielding negative 0.2. So 10-year JGBs, depending on what you're looking at, but there are 10-year JGBs that are currently yielding in negative territory. So there is that as well. And it's a function of the Bank of Japan owns like all of the cheapest to deliver. Like when you're short futures and you hold that to maturity, you are expected to deliver physical, JGBs. JGBs don't exist in the market anymore because the Bank of Japan has sucked up all the supply. And so they own over 100% of a lot of issuances. These are the cheapest to deliver issuances. These are the ones that the short futures positions have to deliver, and they're unable to do so, or they're scrambling to do so, and that's why you're getting insane. You have a negative yield on a 10-year JGB currently as we stand right now. So that's the yield story. It's not so much as the 2-year that's making insane sort of moves as well. So I just wanted to mention that as well. But with regards to you asked me about the BOJ leadership change.
Yeah. I would love to just kind of break that down because, again, I think this would have been kind of the leading story globally in the financial world. We had Kuroda, who's been at the helm over there for such a long period of time. And now we've got the new guy, Ueda, right? So can you just kind of describe just what's going on over there and the significance for listeners who might be unaware?
Sure. Japanese investors, okay, and people when they say like Japan flows, they tend to think of the BOJ or the government, and yes, I guess the government through its pension funds and all that, the public pension funds hold a ton of foreign securities. But when we're talking about buying and selling behavior, like 2022, there's record selling out of JGB or out of U.S. Treasuries from the Japanese, which therefore exploded yields higher and so on and so forth. That's the private sector. It's not the government doing anything, right? So just to keep those are very distinctive things that people need to keep in mind. So the reason it's a duration anchor is because of that very fact. The Japan corporates, households, insurance companies, banks, or whoever, if you have a pancake flat yield curve, if you have the Bank of Japan, who is turning the 10-year yield, which is supposed to be far enough out on the curve that it's the market forces are supposed to determine where that is. If they then made that a policy rate via yield curve control, saying we are explicitly going to pin down the 10-year yield, the JGB yield, at around 0 with certain band limitations, you have a pancake flat yield curve. You have a negative yield on the front end of the policy rate, and you have a 10-year JGB that can kind of fluctuate at, between 25, 50 basis points or whatever it is. It's pancake flat yield curve. And there are trillions in cash from Japanese investors, from Japanese households and all that are in need of yields. Elderly society, it's aging, and there's no yield at home. And so they deploy that capital overseas to Australia, to Europe, to the UK, to wherever, to the U.S. Treasury market, to CLOs, and to horrendous credit products and all that too, and anything and everything in between. So when JGBs are now yielding something, as in if JGB yields go up, that's kind of the anchor getting lifted. But absent that, and still with a lid on JGB yields, it is an anchor to the rest of the global, sort of fixed income universe because that capital is now being pushed out overseas, capping yields everywhere else. It's indirect yield curve control and everything else is basically what it is. So that's how
Okay, let me see.
why that concept works.
So let me see if I understood that correctly. So basically, when you've got a pancake flat yield curve over in Japan, what that does is that forces a lot of the money that would have been domestically invested in the Japanese economy out, and that's part of the reason why Japan has such a large foreign investor like net. I forget the exact terminology there, but why they own so many foreign securities. Yeah, exactly. And so when that money flows out of the United States into other securities like U.S. Treasuries, for example, right, that compresses yields abroad as well. And so a lot of basically like a very important dynamic to understand when it comes to like yields outside of just the United States and Europe and the United States is this kind of Japanese money, pension money, really moving into and out of Japan. Is that about correct?
Yeah, absolutely. And not just that, but it's also it's corporates, and then it's also front running algos knowing that this flow exists and thereby kind of exacerbating or making it a self-fulfilling prophecy and all that. There's also seasonal things. We're in the middle of fiscal year end for Japan is the end of March, and typically seasonally you get repatriation back home, you get selling of treasuries, you get selling of dollars, all that, so they could have like cash on the balance sheets to make a very nice year-end sort of earnings presentation for their investors and all that, and then they redeploy everything out in the beginning of April is how it usually goes to. But yeah, the Japanese capital is a massive force in markets, and so people need to be very much aware of that. It's really by coincidence that I'm here. Like I'd be watching this if I was in South Africa or if I was in Mexico or if I was trading out of Brazil or wherever it is. But yeah.
All right. So now talk to me a little bit about, we've had Kuroda kind of at the lead of the BOJ for such a long period of time. Can you just describe a little bit about, we just had a changing of the guard, right? And Ueda kind of took the reins. Can you just describe the significance of that? And then after that, I'm going to ask you about rising CPI in Japan as well, and whether or not that's going to have an impact on the dynamic that we just described.
Sure. So I just so again, first episode of my show will be covering the Kuroda legacy, so I won't get too much in depth.
Yeah,
But
you got to leave the listeners a little something for market depth here.
Yeah.
So yeah, this will be a nice little preview.
Yeah, and also there's going to be much less of my face in the episode, so at least there's that. But so Kuroda is, in my view, the most consequential central banker in kind of our modern era, if you will, from the let's say post GFC era. Okay, he's been around so he's outlasted all the other central bankers that are currently here. Outlasted, as in like they're on term limits, but Kuroda has had an unprecedented, never been done before second term. So he's been here for 10 years. He's overlapped with the end of Bernanke, just to put things in perspective. Bernanke, Mario Draghi, Mark Carney and all them. And he is actually still technically governor. He just had his last policy meeting, but that handover is happening to the incoming governor, Ueda, who is currently a college professor. Well, I don't know currently to this day, but why does that matter? Well, Governor Kuroda, so the Bank of Japan in general is basically the central bank, the modern central bank for developed markets, including the Fed and the ECB. It's the central bank monetary policy experimentation laboratory. So for this is not Japan's choice or anything. This is not, but Japan leads the rest of the policy, the monetary policy world in policy framework by roughly a decade or so. And that's largely because Japan leads the rest of the world in aging demographics and debt levels by roughly a decade. So the Bank of Japan is forced to do things that are at the time extremely radical and unprecedented and all that. They have to venture out to, kind of experiment with policy and ahead of other central banks. So they, brought rates down to zero, kept them at zero long before the Fed, ECB, all that did in 2008. They invented QE. They weren't the first for negative interest rates, but they currently are the last out of negative interest rates, as in they still exist and I don't know when they'll be out. But there's that. There's yield curve control is the Bank of Japan. And by the way, that yield curve control was designed with the help of Mr. Ben Bernanke, who after his time at the Fed, he flew over to Tokyo. He helped design it because, again, Bank of Japan is literally the monetary policy experimentation laboratory. This is where things kind of like get done, and other central banks are watch the BOJ intently and see the consequences and results of their actions, their inactions, their experimentation. So that's kind of the general background of the BOJ. Governor Kuroda took that experimentation sort of theme to like completely new levels.
Mm,
And he basically has thrown a Hail Mary. We're going to just do like an undoable level of amount of QE. And look, because otherwise we don't have any timeouts left. We have no time left on the clock. And so we have one Hail Mary left. And so he threw that Hail Mary. And you can't buy or more than half of your country's sovereign debt market and then control the prices on the other half, and cause all of these insane sort of like liquidity and illiquidity and market dysfunctioning sort of occurrences to happen, and then unwind that. There's no QT in Japan. There's no unwinding in Japan. So we're kind of stuck here with that, and so he has irreversible policies. So just because the guy is gone, it doesn't mean that incoming guy gets like this whole slew of like options to choose from. Like, what can I do? Like, no, you are stuck in there's no clean slate. You're stuck in the same you have the same like
yeah.
it's hilarious to hear people who say like Kuroda's trapped and cornered. At the same time, they'll say Ueda can do this and that. Like, no, it's one or the other, right? So yeah, so I think that's really key. One thing I'll mention too about Kuroda. So there's like people who know me who follow me. They know me for like I make a lot of memes about Kuroda because he's always giggling and stuff like that, and he's a very memeable sort of character. And which means that that him being gone, I feel like kind of like late night talk show hosts must feel when Trump left, and they're like, oh, we don't have material anymore. But with Kuroda, I think that his giggling and all that might seem amusing or whatever, but that's actually kind of a very significant, serious thing. He has like never buckled under. He's never pivoted or anything like that. Never buckled under pressure. He takes live fire like I've never seen before. And that's really important because I say like instead of giggling and all that, if he like ever looked nervous, had his voice kind of shake or like his like had a drop of sweat roll down his cheek as he's talking about, we will remain firm at 25 basis points and you'll cover. Then the shorts are just got to come in and destroy.
Mm,
So so that presentation part really matters. You're the public face of the central bank. The next guy doesn't have that. Nobody has what Kuroda has, but the next guy is especially bad at that. And so just from that, and again, that's something that really has like it can't be overstated how important that is. That presentation, that confidence, that exuding confidence part, and selling the policy. And so the next guy, he lacks that to a level that's way below any public figure that you'll see. That's really scary.
mm. So, kind of walk me through here, Weston, because basically what I heard you just say is that there has been irreversible policy, basically, in terms of this just wildly negative real rates of interest, and they can't walk this back, right, for a whole number of reasons. And by the way, it's a little bit scary to hear you say that because it seems like we're on the same path, right, over here in the Western world of Japan. Now, walk me through what happens here when inflation, if and when inflation starts to pick up, because from my understanding, we've got a core reading of about 4.3%, I think was the last one. And when we started to see inflation heat up in the United States, admittedly, it took the Fed a little bit longer than I think some of us might have liked for them to react, but eventually react they did, and that's been the major story of 2022 and thus far in 2023 as well. So, walk me through it. It seems like we've kind of got an unstoppable force and an immovable object, right? We've got an immovable object in the force of Japanese monetary policy, but then we've got the unstoppable force in the form of inflation. So what happens when those two things butt heads?
Fantastic question. And I would like you to tell the Japanese officials and government, and not just at the Bank of Japan, but the government itself and the Japanese media and public, that there is a four handle in Japan in CPI. Because I don't think that they got that message, literally. And here's what I mean by that. If you listen to, and I've done hours and hours and hours of this, if you listen to like the hearings of the incoming governor Ueda, his lower upper house, basically the parliament hearings, like the kind of Senate and House confirmation hearings, if you will, which are supposed to be kind of like a breeze, right? But the way that the government like poses questions, talks about inflation, and then Kuroda's press conference at the by media and all that, his final press conference, are all they all talk as if like there is no 2% inflation that has been exceeded in Japan. Like really, like they'll say like, Governor Kuroda, so why, now that it's your last meeting, why do you think that you failed to achieve 2% inflation? Core CPI is up 4.3%. But they talk as if like not only has it not like been above it, but it's never been above it, and it's like miles away, right?
Mm.
And so that might seem insane to Western people, but the thing is that I kind of do agree with what their thinking is, because what the thing is, it's not like you just hit a 2% like print once and then you just unwind, you could stop doing it, right? What they need to see is like actually entrenched inflation, if you will. They need to see that this is not transitory. That's a real term that would exist in Japan. Only in Japan would that be actually real, because Japan is like you and I are talking about, like that podcast, Hardcore History, the Supernova
Love
of
it.
the East. Japan is like everyone else, only more so, right? So
God, Dan
basically,
Carlin is the best.
he really,
He's got to be
really
the greatest. Yeah.
he absolutely
Sorry.
is.
Mhm.
But with Japan, it really is such an enigma. It's so different. I always call it kind of the North Korea of the developed world, of the developed democracies, because it's so like strangely insulated in like weird different ways. So Japan inflation is just very like the deflation to get out of that was like kind of almost impossible to do. Kuroda did successfully get out of that, but inflation is, yeah, it might be at 4%, but it's expected to come back down below 2% by in this fiscal year. And so therefore, you don't blow up the balance sheet to 120% of GDP, which by the way is twice this the size of the next runner up, which is the ECB at 60%. So they have a massive amount of QE. You don't buy up like half the JGB is outstanding. You don't do all of these measures. Start buying equity, the equity market and all that kind of thing, just to see like like a tap into like above the 2% target, while global inflation is nearly double that of Japan. Clearly, this is a global phenomenon. It's not just a strictly Japan phenomenon. If it were just strictly Japan, then fine. But if it's not, then we have to maintain this. If this is what they believe to get Japan to generate self-sustained inflation, this virtuous cycle of inflation, all that kind of thing. If that's what they're going for, yeah, this isn't it. This is a false flag. This is like a false read. So, but it is crazy to think of that in those terms. But the reason that's important is because the Bank of Japan is not adjusting or not adjusting yield curve control or policy at the moment based on
Mm.
CPI. It has nothing to do with CPI. Everyone else would think that it's based on CPI, and they'll think like Japan is now finally reacting to inflation, all that yield curve control has got to go, and all these things are going to happen. That's not the case. Japan is adjusting yield curve control because Japan is has severe bond market dysfunction. That's what they're making their decisions based on. Nothing to do with CPI. So anyone who's shorting JGBs with a CPI based mind frame, you were right for the wrong reasons in December, and you learned that lesson in January and March when they didn't continue to exit this policy. Because
Yeah.
frankly, there really is no exit of this policy.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. Yeah, that's what I kind of keep going back to, which is, I mean, look at what we just experienced over here in the United States, right? We hiked interest rates from, basically 0 to about 5%. And we thought for a period of time, everyone was very surprised that there was nothing that, quote unquote broke. And as it turns out, some of the stress that existed in the banking system was that, yeah, when they lowered yields to 0, and flooded the system with money, then banks had to go out and buy a bunch of bonds at generational highs. And now as that is reversed, right? The U.S. the treasuries that are collateralizing our banking system are under an enormous amount of stress. I can't even. You would have to imagine that that dynamic in Japan is basically that same dynamic magnified by at least an order of magnitude because rates have been kept that much lower for that much longer. And the BOJ owns what, some crazy percentage of the JGB market in general. So it just seems, like letting kind of market forces return to the bond market would just be absolute chaos at this point.
Yeah, if you let if you just ripped off the band-aid and let yield curve control go, and so there's nothing, so market forces determine where a 250% debt to GDP economy, where their bonds trade,
Right.
they're not going to be at 400 basis points below the United States Treasury can borrow for 8 weeks out. Okay, like on
Yeah.
10 year. Here's the thing with Japan's I guess in this there's two forces, and Mike Howell and I talk about this all the time, and you guys are flagging this with your guests on Blockworks as well. But things that could happen are look when you have basically illiquidity, right? When you have so much of the bond market that is illiquid from a trading perspective, you get severe volatility. That's why you have you know swings in the 2-year yield right now are, I think, a lot of that is a function of kind of just illiquidity in the markets in general, and you can see that because that is a sort of more extreme version of that is happening in Japan in the 10-year US the 10-year yields in Japan are moving, like I said, they're moving from 50 basis points to some of them are now trading in negative territory. So the full nominal yield is gone in the last 2 or 3 days. So you could talk about 60 basis points down in 2 years, which is a big deal. But in the worst, swings are happening in the JGB market as well, and that's a function of just a lack of supply and bid offer sort of size out there and available to trade. So when you have a market that's that fragile, if you suddenly just pull the rug from underneath it like they did in December, you're going to find yourself in a massive, sort of destructive situation. So in December, yield curve control is basically, it is an explicit central bank put. We will buy an unlimited amount of JGBs at price level X, 25 basis points, no matter what. Come hell or high water, that's where it is. It's an explicit central bank put. There are models, there are risk models based on that. This is the JGBs, and up until December in 2022 were the safe haven amongst safe haven bonds. Every other bond, basically, if you bought them, you get crushed in 2022. BTPs, UK gilts, US Treasuries, JGBs had a floor on it. So what happens when you take that floor out, or you just double the yield? That's going to create sort of massive destruction of value, as you kind of see with a SVP sort of situation. So I wonder how many of these books are that are just getting crushed right now in terms of their unrealized losses, mark-to-market losses on the JGB portfolios. And in addition to that, in a kind of a longer-term sort of thing, okay, so Japan is the most indebted country in the world. Debt burden is going up. It's getting increasingly more elderly, which means that tax contributors are turning to tax, paying
Consumers.
service receivers, and so on and so forth. And so Japan is not going to be able to pay back the principal on its debt. And currently, 1/4 of Japan's budget goes to servicing its debt. So if that's the case, and they're servicing their debt, 1/4 of the budget goes to servicing debt at rock bottom rates, right, at artificially low rates. What happens when you bring them to the yields up to just 1%, right? So 4x that what it was at yield curve control before. They're not all, it's not this simple, they're all different maturities and durations, but basically what, it's 100% of the budget goes to just servicing the debt, right? So Japan needs to do this. There is no other sort of way. They cannot let borrowing costs for the Japanese government go up, lest they want to not have a country that can operate like a normal developed country. So
yeah, wow, that's shocking. I did not realize that it was that high. 25% of the the annual budget going towards just repaying debt. That is crazy. Now,
and doing so with rock bottom rates.
rock bottom rates, yeah, lowest in the world. But here maybe you could also connect this for listeners, Weston, because we've talked about on this show, and Brent Johnson has done a great job of illustrating this kind of the relationship in between a country's bond market and their currency, right? And especially when you have inflation, generally, maybe not in Japan, that's a new dynamic, but the general dynamic is you kind of have to pick one, right? If you want to save the bond market, you kind of end up sacrificing the currency. Now, I think a couple of months ago, I don't have the exact timeline on this, but we saw the yen, which has historically been kind of one of the safe haven currencies, fall precipitously against the dollar before it sort of recovered. So, can you kind of explain that dynamic for listeners?
Yes, sir. I mean, I saw that interview. I think like because towards the I guess end of last year, like
Yeah.
late last year was when you did it with Brent Johnson. Yeah.
Hmm.
So he's right about fundamentally, the central bank can't do both, right? You can't support both your bond market and your currency market. It's one at the expense of the other. So that's what yield curve control was, right? So you have basically rising rate environment globally, right? And JGBs are not immune to a rising yield environment. So the beginning of 2021 or beginning of 2020, you have Fed funds at like nothing. You have the S&P and Nasdaq were still not in bear market territory, and you have U.S. Treasury yields at like 1% or so. Then you see global yields start to rise very sharply, including JGB yields. JGB yields at that point, by the way, were like around zero as well. Um, JGB yields, however, on the way got stopped at 25 basis points yield curve control cap. They do how do they cap yields? The Bank of Japan offers to buy and actually buys an unlimited amount of JGBs in order to cap yields. Meanwhile, while U.S. Treasury yields, let's say 10-year U.S. Treasury yields continue to go up as JGB yields are capped, the U.S. and Japan yield spread widens. As that yield spread widens, sort of one of the kind of basic fundamentals of currency price action is yield differentials between two countries. You sell the lower yielding currency to buy a higher yielding currency, or you fund with a lower yielding currency to buy a higher yielding currency called carry trade. So as that tenure or whatever maturity, but usually tenure U.S. Treasury to JGB yield spread widens as U.S. Treasuries yields continue to go up, USD JPY continues to go up. As that continues to happen, that's dollar yen going up. That's yen getting more weak against the dollar, down to multi-decade levels and down to 33% at its lowest, worst performing currency in the world.
Hmm.
At one point worse than the Turkish lira. And so it's supposed to be one at the expense of the other. However, here's the thing: Japan is again unlike everyone else, right? So the reason that shorting JGBs is called the widowmaker trade is because
Right.
fundamentally, yeah, you should be shorting the hell out of JGBs. Like the Japan, like this is what's they're worthless. Like you're not gonna be paid back on your principal. You're gonna lose 100 cents on the dollar. That's what it should be, right? But that was a very bad trade because the BOJ is able to lift above economic gravity and kind of deflect economic gravity. And in the same way, what I was saying was that Japan can probably sustain the supporting the JGB market as well as the FX intervention supporting the yen at the same time for longer than we think. So yeah, although it doesn't make sense fundamentally, Japan is kind of it's this outlier that can kind of break the rules of economic gravity and macro gravity, and therefore shorting the yen at like 150 and so all that. That's what I was saying at the time was that might be the new widowmaker trade because the Ministry of Finance might come in and smack dollar yen down 5 yen, 5 handles, in a moment's notice.
Yeah, Weston, we're this was intended to be kind of a teaser, right, for market depth. So we don't want to give everything away for listeners. And guys, you should absolutely go over and listen to this show. But I do just want to briefly ask you in our last couple minutes here. We're right before we started recording, US CPI came out. It basically came out right within expectations. But I'm just kind of looking at some of the initial reactions. We had crypto take off like a rocket ship, right, and explode. We've also got the Nasdaq. I'm just looking at it trading at. It's up about 1.7%, and keep in mind, this is, just about an hour after CPI went live. But I'd love to kind of get your take here and how you think this is going to impact things.
Sure. So it's a really interesting time for CPI to come out because given everything, like, is the Fed going to what's the
Right.
Fed going to do now, right? Like Nomura put out a call earlier today saying that the Fed's going to cut rates at the next meeting next
I
week.
saw that.
Uh,
Yeah.
yeah, that's quite a call to make. Here's what I'll say: the lack of the lack of reaction relative to, right. I mean, the CPI number. It's not like it was like that crazy. It's more or less in line, but still, you always get positioning on both sides. but so much activity has happened, and so much kind of positioning has been already reset, and shorts have gotten squeezed out of like futures and all that, and race futures that and currencies and all that. So it's I think that right now, like there's no way to look at the CPI release and then the market reaction and be able to get any sort of clean read at all. We're in the midst of something much broader and bigger that's taking that's taking over right now. That any sort of market reaction might be an unwind of a previous trade put on yesterday with this sort of Silicon Valley Bank regional bank thematic sort
Mm.
of pivot theme in mind, and so it might not be anything related to that. So I like there's so much background noise, and it's not noise, by the way, it's very real, but there's so much kind of background things to put in context leading up to this, that this is far from typical like here's what the market did in relation to CPI. So I really couldn't tell you. But what I will say, however, is that if Jay Powell and company wants to maintain their credibility and not start a panic, they will go on and lift their Fed funds rate another 25 basis points or whatever it is. But you don't like pause monetary policy after you just were in Congress saying like, yeah, we're going to go, be very hawkish. And you certainly don't start cutting rates right now, lest you want to exacerbate a panic. Don't do what the BOJ did and make a policy mistake from December. So
Yeah.
that's my thoughts. I don't know what yours are, but
I will tell you this. I don't have much more sophisticated thoughts other than I would not want to be in Jay Powell's seat right now because, I totally agree with you. In order to maintain credibility, I think you've got to at least continue to raise by like 25 basis points. It's been absolutely wild to watch the expectation shift from at one point it was, there was a 30% chance that that he was going to raise 50 basis points. Then there was, I think at peak, like an 85% chance, after we got the hot, what was the economic data that got released last week? I'm blanking, but we got some hot data last week, and the rate increased to like 80%. And then now that's basically completely, yeah, it's completely flipped. And this morning we had Liz Warren sending out a tweet, basically excoriating Jay Powell and putting the stress in the banking system at his feet, which is,
he's a
look,
dangerous man.
I just,
That's what she said.
yeah, dangerous man. Yeah, exactly. Now she, yep. So anyway, so I think she's a pretty good.
She's very
Honest,
good at making like headlines and like
I
kind
think
of
she is too.
soundbites. She's
I
a
think
great
she's a
sound.
pretty, and I think she's actually a decent barometer for sort of the zeitgeist of this administration. So that's what I'll kind of say, and I'll just end it by saying I do not envy his position and the decision that he has to make.
Yeah, here's what I'll say though. I also don't envy the positions of other central bankers. And so again, just to wrap up and to kind of plug my my show,
Yeah, please,
but
yeah,
um, I want people to know first of all that yes, I'm kind of most known for being a Bank of Japan expert. There's no such thing as a Bank of Japan expert because BOJ is just completely going like day by day, and so BOJ themselves are not BOJ experts. That said, I'm not strictly looking at BOJ only. I look at China. I look at the PBOC, the people, the amount of liquidity they do, the China leadership change. There's currently, a lot of reshuffling going on within the upper ranks of the CCP. There are, I'm looking at things like the semiconductor space out of Taiwan and of Korea, and how that impacts, because that has global impact as well, geopolitical impact, inflation impact, well, like so on and so forth. I'm looking at Australia for like commodities, mining, all that kind of activity. Singapore, Hong Kong, with regards to like finance. So like the entire region is in play here, and I'm not just looking at strictly at Japan. And increasingly, much more and more market drivers are originating out of Asia. And so that's why you need to be aware. So there's two kinds of ways that I'm gonna do the show. One is gonna be mostly like today's market price action. Here's what happened overnight. Here's what you need to know, and here's how to cut through the noise. The other one being kind of deep dives into bigger themes. This first episode being a bit deeper dive into Kuroda himself. But that's why it's market depth. But those are the two sort of things. So I just want people to know that's like I'm not like just like a BOJ only person or Japan focused only person right now.
Yeah, well said, Weston. And I personally can't wait. I'm going to be tuning into the first episode myself. And listeners, if you've been listening to On the Margin, highly recommend that you tune in and listen to Market Depth. Unfortunately, Weston, that is all the time we have. So, guys, after you're done with this show here, go over and listen to the first episode of Market Depth. I know I'm going to be a regular listener. Weston, thanks very much for coming on the show, my friend.
Thanks so much. Looking forward to it.